Markets have just closed. This is going to act as your market update and the weekly outlook. And let's go through what exactly has happened so far as of last week up until today, what it tells us about where the smart money is positioned right now, and what you need to watch heading into the rest of this week. Because Thursday, we are going to get core PCE coming out. So we have inflation prints that are coming out this week. And it's going to be the most important release of the month, and how today set up matters for how that print gets received on Thursday is exactly what we're going to go over in just a little bit. So let's start off with the macro backdrop. Last Wednesday, we had the Federal Reserve hold its first meeting under the new chair of Kevin Warsh, and it was genuinely consequential. The committee had held rates steady as expected, but the forward guidance has shifted meaningfully hawkish. 9 of the Fed policymakers now project at least one rate hike before the end of this year, which we know is going to happen for sure in December, but the market is also now preparing for another rate hike as early as September. So Thursday's print is going to give us a higher probability or a lower probability of what to expect going into September as well. The post-meeting statement also stripped down to just about 130 words, with all the easing bias language removed entirely. So that is something that the market was also expecting. So now the markets are pricing meaningfully odds of a hike as early as September, and that is the dominant macro force that's still working through the entire system today, even 5 trading days later, basically. Layered on top of that, we have the Iran situation, which moved again over the weekend. Talks in Switzerland produced what meteors called quote unquote encouraging progress, which is, we're getting a roadmap now towards a final deal within 60 days, with the US Treasury authorizing the sale of Iranian oil for the next 60 days as part of that framework. But here's the key thing that matters the most. This is just a roadmap. It's not a finished deal, and we're not treating it like that either. Tehran separately claimed that it had once again closed the Strait of Hormuz over the weekend, even though millions of barrels of crude was still being moved throughout the waterway the entire time. So that gap between what's actually happening physically on the water and the headlines that we're getting is the single most important thing to understand about the story right now, especially as we're moving into this week. So the headlines and the reality, they're not the same thing right now, so we need to continue reading in between the lines. When we're looking at the actual equities and the rest of the pairs that we're trading, equities were kind of mixed here, and the way that they were mixed is going to tell us something about where the market's attention is right now. Starting off with S&P 500, the last daily candle did close down bearish, but you can see how the volume is starting to die down here as well. It was down about 0.4%. Nasdaq had bigger volatility, or a lot more volatility here, where it's starting to consolidate out. It was down over a full percent, and it was dragged by a broad decline across the largest technology names, namely Alphabet, which was the single biggest mover, falling over 5% on concerns about AI talent departures at the company. And then we had Amazon, Meta, and Microsoft all declined alongside it. And then we have Dow that also had much better movements, but also a little bit of consolidation that I was trying to exit out of. So Dow actually closed higher, and almost the entire move came from just one name, which is Caterpillar, up nearly 4%, and that stock single-handedly accounted for more of the index gains than the Dow's total advance that we have seen. So that is something that's worth just noting, for even a second, because without Caterpillar, the Dow would have been negative as well, like Nasdaq and S&P 500. So what does that divergence actually tell you? It tells you that this is not a broad risk on or risk off day. This is a market rotating out of the rate sensitive and the highest multiple names and into old economy industrials, which is exactly the kind of rotation that you would expect to see in a market that's still digesting the hawkish Fed shift that we just got last week, and it's not ready to fully embrace that risk just again. So that's why in today's live session, I said that we're cautiously risk on. So even with some calming news on the geopolitical side, the market is not fully ready to go risk on once again. One more equity specific note, which is separate from what we usually look at, but it's something that I do want to flag because it's dominating the headlines. It's SpaceX. SpaceX has now, let's come back here. SpaceX has now extended its losing streak to a third straight falling session, and it fell sharply again today. The stock is still above its IPO price. Let's pull that up. So it's still up above its IPO price here from earlier this month, but the air is now clearly coming out of that initial post-listing enthusiasm that we saw. And I'm flagging this because, it's relevant context for the broader, quote unquote, is AI infrastructure spending getting ahead of itself conversation that is still weighing on names like Alphabet, specifically today, and especially if you're trading Nasdaq as well. So that's a real connected theme across the market right now that we're looking at. When we're looking at gold as well next, let's pull that up. On the 4-hour time frame and even on the daily time frame, we're starting to see that sitting closer to our weekly support areas as well. So this is one thing that you need to be careful of. It did push back up bullish on some of the lower time frames. We did get a nice retracement up from about 41, I'm just going to call it 41.20 area, and then push back up bullish. But we saw that as the Iran roadmap news gave the market a reason to take some risk off pressure out of the dollar, we start to see that bullish momentum here. But the market is still not fully risk on. Gold obviously is not a risk on asset anyways, but the key thing here is the fact that gold is being impacted mainly by the US dollar strength that we have been seeing. If you pull up DXY as well, you're sitting above that $100 mark, which happened as more risk off sentiment start to come in, more of the back and forth oscillation pattern that we have been seeing with the US and Iran war start to come back into the play, and start seeing more investors rotating back into the US dollar. So with gold, the projections are, especially from Goldman and JP Morgan, they have their projections that we might end up hitting 5,400 again by the year end, but they have dropped that down to 4,900. So what we need to see is maintain support here. From an institutional perspective, gold in theory should be struggling right now, given how hawkish the Fed just turned last week. The higher yield, real yields are normally a direct headwind for a non-yielding asset. So the fact that it's catching a bid anyway will tell us that there's a structural buyer underneath this market that isn't simply trading this week's Fed narrative. We know from recent central bank survey data points that we pulled up this morning as well, that a record share of central banks plan to keep adding to their gold reserves over the next year, over the next 12 months. So that's exactly the kind of buyer that's going to show up on a day like today, when the simple narrative says that gold, should be falling, but it isn't. When you're looking at the dollar and the yen very specifically, so this is a pair that I'm staying away from, but I'm still watching out and just trying to see what's happening here. So this is, the one that I want you also watching most closely this week as well, especially as we're pushing past that 160 level and even 161 level here. USD JPY right now is trading at a level that has historically been the trigger point for Japanese currency intervention. There's also has been news about potential interventions earlier today as well. It's not confirmed, but we did have the Japanese financial authorities openly keeping markets guessing about possible action today, which in itself tells us that this level right now, matters to them in real time. And we also had the Japanese finance minister also saying that, they're keeping an eye on this and they will be interfering again into the markets as USD JPY continues to push past that 160 area. So right now it's sitting at 161 area. So this is your prime live risk that we're still watching for any JPY pair, matter of fact. When you have a hawkish Fed pulling the dollar in one direction and a Japanese government that's publicly uncomfortable with how far this move has gone, that's a genuine two-way risk setup. So this is not a clean trend that you can just lean into without really respecting the possibility of an abrupt or official-driven reversal. So just keep that in mind as well. Another couple of things that I want to note here before we actually jump into the technical side and start looking at our setups for swing trades and day trades and even potential scalps is that the treasury yields have been the key transmission mechanism all week. The move higher in short-term yields following last week's Fed decision is the direct channel through which both the dollar strength and the pressure on the rate-sensitive equities like Nasdaq are flowing. So that's not really a coincidence. That's the mechanism that's working exactly how we expect it to and the way that it's built to work as well. So if you're looking at the 3-year treasury, you're seeing that massive bullish momentum, especially since March. currently sitting at that about 4.239 area, and then come down to the 10-year, currently sitting at 4.5, and then 30-year sitting at almost 5%, 4.9% here. On the institutional research side, we're also seeing real public disagreement emerging about how durable this dollar and the rate path move actually is. Major bank desks have actively been revising their forecasts in both directions over the past several days. So that kind of public disagreement that we're already seeing from articles, Bloomberg, or any other fundamental resource that you use, that is quite serious. That itself is a signal that this is genuinely two-sided market right now. It's not just one-way consensus trade. One thing that I want to flag specifically, for us as retail traders, because I think it's the trap most likely to catch people right now, especially in a week like this. The instinct after a week like last week, where you had a hawkish Fed, you had sharp moves across gold, the dollar, and equities, is to assume that the trend is simply going to continue in a straight line this week as well. Today's price action should tell you that's not what's actually happening, especially when you're looking at US 30, when you're looking at Nasdaq, the consolidation levels that we are seeing here at the moment, and gold as well. We have a genuine divergence inside equities. Gold got caught in an unexpected bid. USD JPY is sitting at a level where an external non-market actor like Japan's own currency authorities could step in and override whatever the technical or fundamental setup looks like there. So trading this week as if last week's moves are just going to keep extending without really respecting that there are now two real wave forces in play at the moment is the mistake that I'm going to be the most careful about this week, and I want to flag to you guys as well. In terms of risk management, before we jump into the technical side, given that Thursday's inflation print is going to be the dominant macro theme here, or the macro factor here for this week, and given that we already have one instrument, USD JPY, sitting at a level with real intervention risk attached to it, I would treat this week as to just stay disciplined on the size. So this is not the week to be, running your risk at the top of your normal range. If you're trading USD JPY specifically, or any JPY cross, if you're trading GBP JPY as well, you need to be prepared about a potential move that isn't really driven by a normal price action at all, but could be driven by an actual policy decision out of Tokyo. On gold specifically, the fact that it's holding up against a fundamentally bearish backdrop means that you should not be chasing a short here without any sort of real confirmation. Fading a structurally supported instrument because the simple narrative says that it should be falling is exactly how accounts get hurt in a week like this. So let's now move over to the technical side. Close these up, come over to, let's start off with Nasdaq since we're already here. On the weekly time frame, you see that overall the weekly time frame is still bullish here, but today's session reinforces what we saw building last week, that there's a clear loss of momentum in the highest multiple names specifically. And when we're looking at this week already creating the top wick but really not breaking the previous highs, tells us that there's not enough bullish momentum here just to continue pushing. I'm going to keep that at 30,700, and I'm going to keep my, actually I'm going to create my support off the daily. So come on to the daily time frame here, and we see that right now, same thing, you're seeing that bullish momentum, but you start to see a little bit of consolidation. So what I'm going to do is map out my support right down here into this consolidation support at 29,800. So the daily time frame here, it's showing genuine distribution in that part of the market, not just a pause within that uptrend. We are seeing how there's a clear loss of that momentum. And then let's drop down to the 4-hour time frame. And this is where you're going to watch for whether this rotation out of mega cap tech is a multi-day theme or if it's just a one-day reaction to the alphabet specific news. So for that, what we're going to watch out for going into even Asian session or London session very specifically is if price can continue holding onto this area, which is at previous resistance, support, break, and retest resistance before a nice sell-off that happened here. We're about almost negative 5% drop, and then a pull back up. So if price continues holding onto this area of support and then continues pushing back up, then obviously that's a one-day reaction to the alphabet specific news. But if it continues dropping below this, then we know that this is going to be a multi-day theme, especially as we're getting closer to the PCE print. So that's what you're watching out for. You can also drop down to the 1-hour time frame, and you have your full pure consolidation right here. If price continues breaking past this level here above 30,400, you're looking for about a 300-point move to the upside for your buy opportunities to come back and tap into those previous highs. So very specifically around 650 or 680 area, so probably just short of the full 300-point move. But if price breaks below the support area here on the 4-hour time frame and continues breaking the previous lows to come back into the support, you are looking at about just over 200 to 300-point move to the downside. So you're going to wait for your clear candle closures on 30-minute, 15-minute, and then a continuation down for that continued move. Anything in between, I would just stay out of it. That's kind of my turning point to see if price is going to end up actually holding onto support and then continue pushing back up bullish, or if we're going to break below these lows and then continue pushing back down bearish. Let's come over to Dow here now on US 30. The structure is a little bit more straightforward here. It's holding up well, even on the weekly time frame, as you can see, and even on the daily basis, you know, a little bit more cleaner than Nasdaq. But today's gain was pretty narrow, and it was, you know, concentrated in just that one single name, Caterpillar, which means that the structural support underneath the index is less broad than the index level number is suggesting at the moment. I would want to see that broaden out before treating Dow's resilience here as more like clean, durable signal here at all. So just looking at pure technical levels, we still have the gap that the market has to fill in from last week. So I'm still going to map out my 51,400 as my weekly support area. If price breaks below that, then we're looking for a clean gap fill for about a 200-point move. As of right now, I'm going to keep my top wick rejection from last week as my zone for this week, which is 52,300. We're going to drop down to the daily time frame. On the daily time frame, you can see how price created a high, start to pull back. It does look like a bit of a consolidation here, but it's a lot cleaner than Nasdaq. Drop down to the 4-hour time frame, and you see that you have this entire consolidation. Matter of fact, just map it out right here. If price can continue breaking above this, then you're looking for about 300, 400-point move to the upside, just even from 52,000 up to 52,300. You've got a clean move right there. What I'm also going to do is narrow in my zone a bit more for my exact sell opportunities. So if I see price breaking below this previous support and resistance and the current support, and then continue down to the downside, then we're looking at about a 200-point move to the downside from 51,600 down to 51,400. Now let's come over to, let's do commodities. Let's do the major pairs that I will personally be watching this week, and then we'll come back to the rest of the instruments that we usually analyze anyways. Now on gold, the weekly structure remains in what I would call more like a corrective phase within that longer term uptrend that we have been seeing, and then a pullback that started to happen. But one thing I want you to notice is that this week just opened up, but last week and the week prior to that, we made a bottom wick, but we have failed to continue closing below these areas and continue pushing back down bearish. Last week's decline tested a meaningful level, but you know, it still held right above it. And today's bounce is the market's first real attempt to establish whether that level is going to function as a genuine support going forward. So what we're going to do is map out that support level here, which is your 4152.5. Drop down to the daily time frame, and here you see that support formation on Thursday, push back up. The market opened up, you know, not last week, but the week prior to that. The market opened up with a gap up, and then we continued pushing down. Same thing on Friday, we ended up closing right above this area, and then right now the last daily candle closed back up bullish, kind of holding on to it as support. So it's not, you know, a clear, genuine support just yet until we can have the current daily candle make a bottom wick and flip back up bullish. But as you drop down to lower time frames and we continue to see these highs being broken, that's going to give us all the indications or all the information that we need to continue pushing back up bullish. So based off the daily time frame, what I'm doing is mapping out the zone here as the previous resistance and the current resistance. If price can continue pushing past that, then we're headed right back up into those previous highs. If you just look at where my cursor is right now and then look to the left, that is your previous support and your resistance area. So that's the cleanest move that we're going to end up catching here as price continues pushing back up. So what I'm going to do is map out that as my weekly range. 43.36. And then one other pair that we just talked about, USD JPY. The structure here, generally compressed right now. The price is pressing into a zone that has been defended by the official intervention before. So even if you come back up onto the monthly time frame, the massive push up back in June 2024, that's the exact level that we're rejecting off of, and then pulling right back down. And then that's the exact area that we're tapping into at the moment with those top wick rejections too. So you can map that out. $161.9 or even 162. I'll just do 162 here. So that level right there, which means that normal technical structure is going to become less reliable the closer we get to this level, and the closer we stay close to this level as well. So I would want any directional read here to be treated with any sort of real caution before we actually see how this resolves. Now dropping down to the daily time frame, we've had a break and retest setup. What I'm going to do is map out the support right underneath this bearish candle's bottom wick. If I look to the left, I want to see if there's any sort of reactions here. So here, back in 2024, what I'm going to do is actually bring this down so then it sits right into the support. So that's a clear level that we're sitting in at the moment, which is 160.7. All right, come back up to the weekly, checks out as the previous resistance too. So this is where we're going to be extra careful. Even if you are, let's say, scalping this or day trading this, you do have a really good opportunity if price can continue breaking below this previous resistance and then continue pushing back down bearish. Just remember that you will get stuck in a lot of wick rejections. Make sure you understand that a lot of wick rejections will be happening across all JPY crosses. This is something that I'm still monitoring, but this is a more elevated high risk pair that's basically that we're just going to be monitoring to see what ends up happening. Because if you haven't watched that USD JPY video that I just posted on YouTube, please go watch that. But in there, I basically talk about how whatever happens with this pair here or any JPY crosses with their intervention is going to affect all the equities, all the commodities, and even we have seen it affect crypto in the past as well. So these are some of the key things that we want to be watching out for. All right, now let's come back to the rest of the pairs. Since we're in currencies, let's just continue with that. Now looking at GBP USD, same thing. As we're going to see more rotations out of the US dollar, you're going to continue to see GBP USD and Euro USD bouncing off of these weekly support areas. So that's your 1.32 area. And then we have our weekly range already. So map out that top wick into 1.33. Drop down to the daily time frame. So we have a clear indication of support being formed here. Understand that this is a liquidity area. How do you know it's a liquidity area? Every time price has exited out of this or bounced off of it, there's a ton of bullish volume to the upside. So that's what we're trying to capitalize off of. What we want to see to start capitalizing on that is if price can continue breaking above this previous resistance area and the current resistance area, then you start off with obviously a very small range, about 40 pips. But after that, you have a continuation up for about 172 pips. As you see more rotation out of the dollar, we see more optimism, more peace basically on the headline side. Then you're going to see a continuation back up, bullish, potentially looking for a trade from 100 pips up to 374 pips, which is supported by the data points here to the left. So still treating this pair as a swing trade opportunity purely. If we see more rotations into the dollar, let's say there is more risk off headlines that are coming on, let's say they're not really able to figure out, the Lebanon issue with the U.S. and Iran war and all of that, and the Strait of Hormuz closes again, or any of that type of situation happens. Let's say PCE comes out hot as well. We're looking at more rate hikes and whatever. You're going to see a continuation down for those sell opportunities. You have a nice sell coming down for about 136 pips or 40 pips, depending on your entry. So what I would do is just set alerts above and below, and you're solid. If you want to catch a quick scalp, you can here for a continuation up. I'm going to take a little bit of a more conservative approach for this pair, given that we are sitting in a daily consolidation area here. Now looking at Euro USD, quite similar to GBP USD, and same exact fundamentals that we just discussed for GBP USD when it comes to the dollar. So you have your 1.142 as your weekly support. We have our weekly previous support, current range, at 1.151, drop down to the daily. So on the daily time frame, we're kind of in the early stages, unlike GBP USD, which already has established a support. This one seems to just be pushing back down bearish. So I'm trying to see if this current daily candle is going to give me a bullish candle closure at the zone or above it. Then same thing, you just look for a zone to zone trade and you're looking for a pushback up bullish for a range of about 90 pips, 100 pips, depending on your entry, but also checks out as another liquidity zone for a continuation back up. So as you start off with that counter trend trade, you're going to wait for price to close above that 1.151 area and then continue pushing back up bullish. You turn that about 90 pips into about 186 pips, and then a continuation back up bullish for same thing, looking for about closer to 400 pip move here. I'm going to be treating this pair as a swing trade as well. But let's say the US dollar continues to strengthen, or for some reason the euro continues to weaken, then we're going to look for those sells, but I want candle closures below this area and then a continuation down. As that happens, I'm using my reference points here to the left, starting about 110 pips, continue down for about 200 pips, and then ultimately coming back down for about 329 pips. Looking at GBP JPY, same thing, you have the intervention risk from JPY. You have your T12.7. You've got your resistance right here at the top of the weekly consolidation. Drop down to the daily. Last daily candle, gap down right when the market opened up, filled in that gap, came to the top of the range here, rejected all of that, pulled back down, and you can see how we have done that in the past year too. So as long as candles continue to close below this area on the 4-hour and the 1-hour time frames, you still have your scalp or your day trade opportunities. Let's say you want the previous 4-hour low to be broken. Continue pushing down for about 50 pips and then coming all the way down into the zone for about 107 pips. Right now it's just holding onto a support here. We don't really have a clear direction. But if you ended up looking for buys here, you would wait for the current 4-hour high and the previous 4-hour highs to be broken and then to the upside for about 60 pips. I'm staying away from any JPY crosses this week. I'm just monitoring them. Then we have silver. Also just holding onto a support here, as you can see, similar to gold. But the current weekly candle really has no clear direction, as you saw that it's currently like a doji. So what I'm going to do is map out the support from the previous candle bottom wick rejection, 63.245 or 25, any of that. And then I'm also going to map out the previous support here, which is the current weekly candle's top wick, 67.064, drop down to the daily. Last daily candle closed bullish, the current daily candle, no top wick whatsoever, so we're still holding onto a support here. Let's say you wanted to scalp this. Right now it's a pretty tight range, but you can still scalp it. You just create a zone right underneath the daily support area, drop down to the 4-hour time frame. You see how that's consolidation. So you're just looking for, if price drops below this, there's really nowhere to go but down here into the support for another bounce, quite similar to a price action like that. But if price ends up holding onto support here and then continues pushing back up bullish, you narrow in your zone, you take no trades in the middle, you just wait for price to break above this, continue pushing back up bullish, and then to the upside. So that's pretty much it. Looking ahead, tomorrow the calendar is a little bit lighter. We do have some PMI data points that are coming out, which is the main release globally from the Eurozone, from GBP, and then also from the US. Wednesday is going to bring in some more low impact news for us, some new home sales data points that are coming out, crude oil inventories also that are coming out. And then Thursday is the day that matters the most this week, where you have the personal income that's coming out. Right here, personal spending. You also have the final GDP that's coming out, unemployment claims that's coming out, and of course, core PCE price index that's also coming out, which is the Fed's own preferred measure of inflation. So given everything Warsh's committee signaled last week, this print is going to be read as either validating that hawkish pivot or calling it into question, and either outcome will move every instrument that we have talked about tonight into the overnight and through Asian and London session. Keep an eye specifically on USD JPY and any headlines out of Japan's Ministry of Finance. That's the most live, immediate risk on the board right now, separate from anything that's scheduled on the calendar. So that's where we stand. make sure you guys are following proper risk management. We will have our Wednesday live session this week. It will be at 7 a.m. PST. So you guys will be able to watch that on YouTube as well. If you have any questions, just feel free to reach out anytime on Instagram at ShermaFX. And please make sure that you stay disciplined this week. Respect the two-way risk that's already built into this market right now. And I'll see you guys on Wednesday.